right? Citi upgrades U.S. equities to overweight. Morgan Stanley's Mike Wilson, he was with me the other day on Closing Bell. He was on Squawk this morning, in which he said the lows are in for the year. The technicals are now your friend again. Wolf talking about that. Weekly trend work turning bullish for the S&P. Tony Pasquarello, Goldman Sachs, head of hedge fund client coverage, says, I spent much of the past 6 weeks trying to work out why the S&P was so resilient. In that search, a few things came up again and again. One, the market never lost confidence in the underlying durability of the economy. In turn, earnings expectations trended higher. That's the story. That's why people tried to look through the war and look through the spike in oil, because they believe that the economy and earnings were going to remain resilient. And that's why, as we said, you're about 1%. You're less than 1%. Now you're like 2/3 of 1% on the S&P, away from a new all-time high.
Yeah, I think the earnings and the fundamental situation help people stay in the market. Now they're going to get paid for staying in the market and paid for that earnings in macro backdrop. And I do think the momentum, obviously, when you have the snack back plays on some of these stocks that are up double digits that were down a lot, Scott. But I still think that you're going to see, look at how small caps have done. Look at how value's done. I think from a longer term perspective into 2027, we are still going to see better areas work. It's not just going to be all about tech, but we'll take it where it is. We like the tech stocks when they go up. We're fully invested in tech and communication services, and so we've enjoyed this rally.
All right. Since November of 22, the SOX is on pace for its longest rally since October of 2017. It's up 15.5% over the last month. Belski.
Yep.
You sold Texas Instruments.
I did.
Joe owns it. Why'd you sell it?
Texas Instruments is one of 4 names that were casualties from our dividend growth portfolio that we sold. The reason being is that we see stronger dividend growth in other areas, including utilities. But in the case of Texas Instruments, one of our key metrics when we build a dividend growth portfolio is cash flow yields above the dividend yield. And given the poor performance of the stock over the last few years, dividend yield obviously has gone up, and the spread between dividend yield and cash flow yield has gone down. So there's other areas to buy, especially dividend growth areas, and that's why we sold it out of dividend growth.
You know, we're also looking at software today, which remains a pretty good story. Let's look at IGV. There it is. There's your run over the last, couple days. It's not definitive of anything yet, but remember, $77. It's approaching 80. 77 was the Krinsky line in the sand. Now, once it got over that level, it was, at least to him, confirmation that maybe the bottom was in. And others have gotten on that bandwagon as well. The IGV is up 5% this week. Best day in a year. 52-week low on Friday. Josh got stopped out of it last week. Oracle is coming off its best day since mid-September. It was backing that up today, too. Let's look at that. Look at that week to date, 19%. Kidding me? You trimmed it because of the move that it's had, or you got other reasons?
No, we trimmed it again. That was another casualty from dividend growth, but we remain fully invested with respect to our U.S. focus portfolio and our value portfolio, the names that we are quite sizable in Oracle, and that's really what we talk about in terms of tactically over the next 12 to 18 months on a fundamental basis. We have not sold our Oracle. We've maintained our positions, and we believe in the company.
So one out of the 33 portfolios that you have, you
one out of the 4 U.S.-centric portfolios, yes.
Okay. But you still have it in the other portfolios.
Yep, those are our biggest positions, and our U.S. focus and our U.S. value for Oracle.
Okay. I got you. Brian Belski has several new buys. One of which, it's always kind of awkward when it's our parent company, Versant Media. We're happy to have you as a shareholder. I'll say that, but I don't
why?
need to.
Yeah, they're like, why?
Yeah, well, because we got it going on. I don't know. Well, just tell me about the other ones.
Okay.
Tell me about the other ones. It feels like self-serving to have you do that.
No, I mean, let's just say I love the communication services sector.
Okay.
I think cash, content, and consolidation. And Versant fits all of those themes. So let's move on.
Okay, so Versant Media was on the list. Mobileye,
Yep.
Revolve Group. What is that? And Cognex and Gates Industrial.
Mobilize autonomous vehicles.
I know what Mobilize is. What's Revolve Group?
Revolve is an online retailer where the Gen Zs are buying stuff, and I think that's going to be a big thing for them. Cognex and Gates Industrial are two industrial companies that really focus on robotics, and we're adding all of these names to our small mid-cap portfolio because, as you mentioned at the top of the show, small cap stocks have been ripping. We think you need to own more names overall, so we're going to continue to add more names as we go on, and 3 or 4 new names a month.
Okay, appreciate that. There's the rise in Mobileye. Brian, so you sold Warner Brothers Discovery. Was this a swap?
1 for 1.
Versant.
Yep. 1-for-1 switch.
Warner Brothers.
Yep.
Out.
Warner Brothers out.
Because the event has happened.
The event has happened. We think it's going to go through. At the end of the day, we kind of like the turn. We like this Versant company in terms of where it's going and where the content is.
Okay. We do too. Yeah, just throwing it out there.